I'm Greg Thomas, the Managing Director of 375 Park Associates, and welcome to Insights at 375 Park. If you're a business buyer, investor, or deal maker, this is where we break down key M&A trends, financing shifts, risks to watch, and what's next in the market. This week we're covering are M&A deals finally picking up? We'll take a look at what's happening with valuations and buyer sentiment. Also, is bank financing drying up? The latest on the SBA, interest rates, and alternative lending. Further, we'll look at hidden risks buyers are facing in today's markets and how sellers are preparing for exits in 2025. Last, we'll look at the new tax policy and the uncertainty around it and how that's impacting deal flow. Well, let's get into it. So first up, we'll take a look at the M&A trends and deal flow insights. Let's start with the big question. Is M&A activity bouncing back? Well, from our perspective, we've seen a 15% increase in lower middle market transactions this week compared to the same time last year. This is a sign that deal flow is stabilizing. For example, multiples are adjusting, buyers are no longer overpaying like it's 2021, but sellers are still holding on to old valuation expectations. In addition, certain industries are seeing stronger deal flow. These include automotive services, healthcare, and professional services, especially accounting firms. But some sellers are still hesitant, especially in industries facing margin compression or operational uncertainty. What's the takeaway? The market is shifting. If you're a buyer, patience is paying off. If you're a seller, you need to adjust your expectations. Let's get into financing and capital markets. SBA lending remains tight, and we're hearing this from deal makers across the board. First, banks are demanding stronger cash flow coverage than before approving loans. Second, seller financing and earnouts are becoming critical to closing deals. Also, interest rates have dipped slightly, but lenders aren't rushing to finance riskier deals. Valuations are adjusting, but they haven't fully reset. Many sellers are still anchored to 2021 pricing, expecting pre-interest rate hike multiples. However, buyers are pushing back, and we're seeing more deals with structured earnouts, seller financing, and adjusted EBITDA calculations to bridge valuation gaps. If you're structuring a deal, focus on de-risking it with seller financing to align incentives, revenue-based lending for flexibility, and larger down payments to ease lender concerns. What's the bottom line? If you're waiting for cheap money to return, don't hold your breath. M&A is still happening, but you need to find a stronger financing strategy. Now it's time to take a look at the hidden risks in business acquisitions. There are really three red flags that we're seeing. The first one is fake profitability. EBITDA looks great until you dig behind the numbers and you find inflated add backs and one-time revenue spikes. The second risk that we're seeing is key person risk. If the business is too reliant on an owner, a customer, or a supplier, the relationships that could walk out the door after closing, that's a challenge, and it's something that buyers need to take a look at. The third risk is an industry decline. Some industries look stable today, but are they actually shrinking? These include industries like print media, small-scale agriculture, and bars and pubs. How do you avoid these bad deals? Well, you want to validate add backs. Dig deep into the financials. Test customer relationships. Are they loyal to the business or are they loyal to the seller? Look at the future industry trends. Don't just buy based on past performance. The best M&A deals aren't just profitable today, they're sustainable under new ownership. Now it's time to look at business growth and exit strategies. So we're going to look more at the seller's perspective. And really it's how can you increase your business value before going to market? What we're seeing are some key trends in exit planning. First up, buyers want clean financials. Recognize this. Start to normalize your earnings and remove unnecessary owner expenses early, in some cases a year or two before you plan to go to market. Then, recurring revenue boosts valuations. If your business lacks a subscription-based or contractual revenue, it may be harder to sell. You might also want to look at ways that you could remedy that before bringing it to market. Last is operational systems matter. Buyers are paying premiums for businesses that run smoothly without the owner. If you want to exit in the next 1 to 3 years, you should start de-risking your business now. Now we're going to take a look at tax policy because it's having a direct impact on deals. Tax policy uncertainty equals market volatility, and investors and business owners are in wait and see mode. The question isn't an election, it's whether Congress will extend the Tax Cuts and Jobs Act or introduce a new tax code, one that supports reindustrialization while providing relief for workers and small business owners. What's at stake? Well, capital gains and corporate tax rates to start with. Will they rise? Will they stay the same? Or will they shift based on new policy priorities? Incentives for manufacturing and reshoring? Will new tax structures accelerate the Made in the USA movement? Also, small business and pass-through tax treatment. How will new policies affect Main Street deal making? Expect the deal flow to slow in the second quarter as buyers and sellers wait for clarity. Once there's a direction on tax policy, expect transactions to accelerate in the end of the year as business owners adjust strategies based on new legislation. What's the bottom line? Business risk in 2025 isn't just interest rates, it's tax uncertainty. Smart deal makers are factoring it into their models now instead of waiting for Washington to decide. Well, that wraps up Insight at 375 Park for the week of 17 March 2025. Some key takeaways. Deal flow is improving, but valuations are adjusting. Financing remains tough. Buyers need to get creative. Hidden risks can make or break an acquisition. Also, sellers need to prep early for a successful exit. Tax uncertainty will impact deal making. What's your take? Are you seeing deals getting done? What's the biggest financing challenge in your space? Drop a comment below. We'd love to hear your insights.